being recorded.
I can always now explain. For today, I really wanted us to focus on the matter of income tax. Yes, indeed, there are other tax regimes or tax obligations that I'm sure you're familiar with. You know, talk of the value-added tax (VAT), talk of the excise duty tax, talk of the customs duties. Yeah, these are just some of the common taxes that we all know, but definitely the most significant tax that the government is always looking forward to is what we call income tax. So within income tax, this is where we can always talk about the pay as you earn. So that is the income tax that is accounted for by those who are in employment. Then we always have what we call corporate tax. That's the income tax that is accounted for by incorporated bodies. You know, talk of companies, the trusts and all that. And then we also have the so-called, for instance, residential rental income tax. So that's the tax for the landlords, the income tax for the landlords. Capital gains tax also still falls under that same tax obligation called income tax, and that purely targets the properties, whatever money that we are making when we sell properties. So those are just to mention, but that income tax is what I really wanted us to focus on today, but to purely look at it from the doctor's or your profession's perspective. So under the, okay, yeah, I can see the comments on the issue of the slides. Indeed, if there's a challenge, maybe I can be given the rights to share my screen. Yeah, but meanwhile, yes, we can just scroll to the next slide. Yeah, so still under the agenda for today, I will be able to just take you through what exactly income tax entails, and most importantly would be to bring it down to your profession in terms of what are the classes of income that your profession is always exposed to. Once I am done with taking you through that, I'll then be able to now guide you on what you now need to consider in terms of not only record keeping, in terms of what you really need to maintain in order to enable you to be able to compute your income taxes at the end of the year. For instance, right now, we are in that month where we need to file our returns. What is this information that is required in order, or that will comprise an income tax return? Okay, thank you. I can see I am able to now share my screen. Okay, so if I can just get an alert from you if you're able to see my screen. Anyone maybe on the chat, you can just confirm that you're able to see my screen.
Yes, we can.
Okay, thank you. So now, the second item on the agenda, having introduced you to, the topic of, first of all, how to identify what are these sources of income that your profession is exposed to, and how to gather the information that will be necessary for computing your taxes. The next step will be now to, show you exactly what are the requirements in terms of the filing of your returns. Definitely, the income tax return is the tool through which you're supposed to, declare and also show how you've computed your taxes. So I'll be able to take you on a live demo of, that process. Then finally, I'll be able to just quickly make some brief comments on some of these other taxes that you need to watch out for, especially when it comes to issues like withholding tax. Okay. So if I can start off, when it comes to the topic on income tax, the two concepts that you really need to understand is there's what we call the residency concept, which is indeed very, very important. And then there's what we call the source of income concept. Yeah. Now, when it comes to the residency concept, the reason why it is very important, the law here in Kenya only requires a resident person to declare all the incomes that he has earned, whether from Kenya or outside Kenya. So if you qualify to be called if you qualify to be called a resident here in Kenya, then rest assured that whatever incomes that you're making, whether it's within the Kenyan borders or outside, at the end of the day, you're expected to declare all that income here in Kenya. On the other hand, if you are declared or deemed to be a non-resident, then the Kenyan tax authorities will only expect you to declare the income that you have earned here in Kenya. So how exactly do you determine whether you're a resident or not? Now, residency is defined from two perspectives. Number one, there is what we call a permanent home. If you qualify or if it is interpreted that you have a permanent home here in Kenya and you are around here in Kenya for whatever period during a calendar year, then you'll definitely be deemed to be a resident. So the question on what a permanent home is has always been debatable. But what is happening is that at least this year, there's what we call the Finance Bill 2022, which you had Parliament passing the other day. It has now come out clearly to define what is this that is called a permanent home. So a permanent home, in the new law, will refer to a place where all your personal and economic interests are centered. So obviously, when you talk of personal interests, we are now talking of your relations, your relatives, yeah, talk of your family, yeah. So if it is indeed deemed that your relations are based here in Kenya, then your permanent home will be interpreted to be here in Kenya. So it has nothing to do with that physical structure, a house as it is, but it has to do with, the circumstances, your personal and economic interest. So economic interest has to do with, how you're earning your living. So if it is held that Kenya is where, maybe you're running your business or you're employed, then it means this is where your center of economic interest is located. So that alone will qualify you to be a resident. It has nothing to do with citizenship or anything. You can be a foreigner, but if indeed it is proved that your personal and economic interests are here in Kenya, then definitely you'll qualify as a resident. Now, on the other hand, there's a situation whereby, for instance, if you don't have the so-called personal and economic interest, how else can you be deemed to qualify as a resident? Now, this second criteria usually has to do with the number of days that you're around. So yes, you can be a foreigner who probably has personal and economic interests outside Kenya, but the minute that it is proved that in a calendar year you've been based here in Kenya for over 183 days, then you'll be deemed to be a resident in that year of income. Yeah. On the other hand, there are those instances where now, people would prefer to, for instance, circumvent that criteria or that rule of 183 days, which is basically 6 months. And maybe someone would prefer to be, let's say in the year 2020, you come here for like 90 days. Then in the year 2021, you then hit another 90 days. So you play around with it like that in terms of trying to make sure you don't attain the so-called residency here in Kenya for tax purposes. So what the law continues to say is that if in a series of 3 years, it is noted that you have been around in Kenya for a total of 120 days, then going forward, in the following year, from that third year, going forward, whatever number of days that you decide to show up in Kenya, you'll be deemed to be a resident. So that should always be the starting point in terms of asking yourself whether, sorry, I think there's some, maybe all members can just mute their microphones to reduce the interruption. Okay, thank you. So now, that residency concept definitely is relevant to you guys, because I've always had those instances where doctors come and ask me, maybe they were outside Kenya studying, yeah, probably for like 1, 2, 3 years. They were outside there studying, and they come back and they're like, okay, maybe outside there they were also making money in one way or the other. And when they come back to Kenya, they're like, so how should I go about my declarations? So that residency concept should guide you. If, yes, indeed, if you have a permanent home, but you never stepped into Kenya in that year of income, then it means you will be allowed to declare nil returns. Because again, the expectation always is that wherever you are, you are definitely paying taxes in those jurisdictions. But then there are those scenarios whereby probably you ended up being taxed in that other country, and since you also stepped in Kenya, maybe for some, maybe at the end of the year, or you even came and also worked part of your time here in Kenya in that year, then there's always that other concern of double taxation. Yeah, why would the law expect me, since I have clocked 6 months in Kenya, but I also clocked like 4 months outside Kenya and made money there, why should I pay tax on both incomes? So that's where the aspect of double taxation comes in. And what double taxation, or rather the measures that the law has in order to cover you, is that in the event that Kenya has signed up a double taxation agreement with the country in which you are in, then definitely that should be able to protect you. So the list of countries which Kenya already has a double tax agreement are always readily available on the Treasury website, yeah, the Ministry of Finance website. But yeah, definitely that's information that I can always relay on to you. And having mentioned that aspect of double taxation, what usually happens is that most double tax agreements will require you to provide the proof of taxes that you have paid in that other country before you become exempted from declaring those incomes here in Kenya. Now, the other question that I'm sure most of you will ask is, okay, how will maybe the tax authorities here be able to know that maybe I was making money somewhere outside there? Yes, indeed. When it comes to the enforcement measures that the local tax authority is coming up with, they're still far from catching up with some of these scenarios. Just to be honest with you, right now their focus actually is on the so-called companies which are having the so-called cross-border operations. That's where the focus in, because at the end of the day, the argument has always been the taxman will only want to focus on the big money, where the money is. Yeah, so that is not to say that you can get away with it. Definitely they have all these other mechanisms of always trying to catch up or get up with you. For instance, if for instance they just come in and decide to initiate an audit or instigate an audit on you. You know, some of the records they always ask for are things like your bank statements. And if indeed it is traced that, you know, maybe there's this money that came into your statement from outside Kenya, then that will be one way of them catching up with you, including other various ways, you know, which they have put in place in order to just catch up with tax evaders. Okay. Now, the other concept that I wanted you to understand is the source of income concept. The source of income definitely has to do with where has your income originated from and what class of income is it. Now, in terms of where your income comes from, if you go back to that residency concept, as I mentioned, if you're a resident, you're supposed to account for income tax on the sources that are both here in Kenya and outside Kenya. But if you are an non-resident, you will only be required to account for income that originated from Kenya. Yeah. So what are these sources of income that you need to be aware of? So right now, the law here in Kenya only recognizes the incomes that I've displayed here. So definitely we have the common one, which is business income. So business, you know, it's defined as you know, any venture, yeah, any venture, any vocation that at the end of the day derives what we call a gain or a profit. Yeah, so that is very wide. Yeah, the other source of income is another common one, employment income. Yeah, so here we are talking of any scenario where you are contracted to render your services. Then the other source of income, you know, for those who own properties, whether it's commercial, whether it's residential, we have what we call the rental income. And then most recently, what is now really, really picking up has to do with what we call intangible assets. Remember, when you talk of rent income, here we are now talking of tangible assets, you know, the physical property, real estate and all that. But then we have what we call intangible property. So this is where the intellectual rights and all that, for those who are in pharmaceutical industry, probably you are aware of that. You know, if you are able to get a trademark or get your formula, you know, registered under you, that becomes your intellectual property. And if you make money out of it, that is what we now call royalty income. So royalty income is, you know, what you get out of intangible assets. Then for the farmers, you know, those in agriculture, yeah, whether it's you know, livestock keeping or whether it's you know, crop farming, all that falls under that source called farming income. Then yes, I've had you know, like now, if you are members of the KMA, at the end of the year, definitely there's the whole issue of distribution of dividends. Yeah, any investments that you have outside there in what you call marketable securities, where you expect dividends, that's a different source of income. Interest, again, that's another one. Your SACCO definitely is you know, making interest income from what it lends to you, so that is always treated as another source of income. Then a new one here that was introduced in the year 2020, we have what we call the income earned through a digital marketplace. So this is where they're trying to you know, loop into the tax bracket all these innovative ways of you know, making money from online from online markets or online sources. Yeah, all these digital products that you always hear of. I know in your sector there's MyDawa, there's you know, those Call a Doctor online. Yeah, all those online sources, they're now being classified separately under what we call digital taxes. Then digital income, sorry. And then there's those who decide to sell off properties. Yeah. Again, there are those who own what we call whether it's okay, we call them capital assets. Yeah. So these can either be the marketable securities, the shares. Yeah. It can also be assets like land. Yeah. So the minute you make any money or gains from selling such, that's what we call capital gains. Then we have what we call the extractive sector. So this is all about minerals. Yeah, this might not be relevant for us today. And then finally, we have what we call anything that is deemed to be income under the law. So this always comes in different ways, in the law, and it's just a way of giving the commissioner of taxes that discretion to probably expand, this definition of what you call sources of income. Okay. So if we can now bring it back home, what are the common sources that your profession is exposed to? So most medical practitioners would always be contracted by the public and the private health institutions that are around. And in that case, that will always be classified as employment income. Now, at the end of this, I'll also want to explain to you the relevance of understanding these different sources, because it has an impact. Later on, when we go to filing of the income tax return, you'll be able to see why it is important for you to know what source do you fall under. So other than employment income, for those who now decide to either allow me to use the word moonlight, or if not moonlight, they outrightly, avoid employment and decide to, maybe act as consultants. Yeah. Maybe earning the locums or, whatever professional fees that you earn as a result of being a consultant. Then in that case, you will still, we can call it consultancy income, but then again, for tax purposes, this will always still fall under what we call business income. Now, the reason why I've separated it from the last bullet, which I'm calling business income, I wanted to, create that picture of that category of professionals who decide to end up opening their own facilities or institutions, which is what I would prefer to call, or classify under the business income. But yeah, the consultants, they also earn business income, but then again, it's a bit different if you're not running your own facility. Good. Now, the relevance, just before I go to the next one, the relevance of getting to understand all these sources of income is that when you are computing your taxes, you are supposed to classify them separately. So if in a year of income, you have your business income, maybe you're a consultant and you've been earning your income, you're supposed to arrange your numbers separately for that line of, or that source of income. At the same time, if you're also employed, that should also be a separate source, which you're supposed to have your own separate records for that. And then if probably you also, have all these rental properties around and you're earning rental income, again, that's a separate source that you should not mix with these other sources. So what do I mean by you should not mix with other sources? The logic here is that if, for instance, your business income can be proven to be in losses, yeah. Remember, as a business, you'll always prepare your profit and loss account where you just outline that this is all the revenue I earned, and then less these expenses that I earned. And it's normal for you to even report and say, I actually made a loss in that year. Yeah. So what happens from a tax perspective? We would the law wants you to actually utilize the loss for that year in subsequent years. Yeah. So what that means is that in the following year, if maybe you're in a profit, you will be allowed to reduce that profit with the loss that you made in the previous year. So until you utilize all that loss, whatever positive figure that you'll have is what you will now have to declare for tax purposes. Now, at the same time, it is important to understand that that aspect of utilizing losses can only apply in a specific source of income. So what I mean here is that if your business income is in losses, but your rental income is in profits, you cannot come and say, I want to offset this rental income against the loss I made from my business. That is not allowed. And that concept is what we call the separate sourcing of income. So all your income should always be looked at separately. Yeah. And that is something you really need to be keen on. And that's why you will not, for instance, be allowed to use expenses that relate to a separate source of income against another separate source. Yeah. So all your incomes should be able to justify whatever expenses that go with it. And in the event that you mix up any of those expenses, then you'll always be deemed to have done the wrong thing or understated your income. Now, again, what happens with this concept of separate sourcing is that there is also that aspect of different sources being taxed differently. For instance, if you are earning rental income emanating from residential properties, the law says that there's a smaller tax, or a small tax rate will apply to you. There's a tax rate of 10%, which is always applicable on a monthly basis on the gross rent that you receive from the residential properties that you own. So what that means is that at the end of the year, even right now when we are talking about filing your income tax return, that return should not declare the so-called income from residential properties if indeed you have been accounting for the monthly 10% tax. So that again is also very important. The other thing you'll notice, for instance, when you talk of incomes like now the so-called interest income, remember, for all individuals, the withholding tax that you are charged on interest income, yeah. Let's say you've decided to invest in treasury bills, treasury bonds, the one that CBK usually issues. What happens is that in the event that you've invested in an asset where withholding tax has been deducted, then that withholding tax will be a final tax. It's usually at 15%. So what that means is that when you are declaring your your income in your return, you're not supposed to declare that income. Reason being, as an individual, the withholding tax that applied to that interest income was final tax, and it's not supposed to be taxed any further. So that's the whole idea why you really need to understand this concept of the sources of income and their separation. Yeah, you should never mix any of them and subject them to the same tax treatment. Okay. So I want to now discuss another interesting common aspect here. There's usually this debate between what's the difference between an employee and a consultant. Now, from a layman's perspective, one would always say that as long as I don't have an employment contract, then I'm definitely not an employee. Yeah, I'm a consultant. That is what a layman would always interpret to be the difference between an employee and a consultant. But when it comes to the tax circles, it becomes a bit different. The difference here has to do with some criteria that have already been set in the law. And this criteria will imply that whether or not you have something in paper that classifies you into either of the two, employment contract or consultancy contract, at the end of the day, the taxman will only come to watch out for these 4 criteria that I'm about to take you through. And in the event that, probably you avoided the employment aspect and decided to serve as a consultant, because remember, the taxes for employment, that's pay as you earn, are always higher compared to the taxes on consultants, which is a withholding tax of just 5%. So most people would always want to deem themselves to be consultants so that they only suffer the 5% withholding tax. But now the law comes in and says, can you please confirm whether these criteria apply to you? So the first issue here has to do with what we call mutual obligations. Now, mutual obligations is usually looked at from a perspective of, especially if you are in employment. Your employment contract will always state and say, these will be your obligations and your duties. Yeah, your duties and obligations as the employee. On the other hand, it will also say that this is what you should expect from your employer. These are your employer's duties and obligations. So there's always that aspect of, a master-servant relationship, if I may put it. So how a master-servant relationship works is that the master will always dictate on the servant in terms of what to do. Yeah, so the master will always put it down on paper and confirm to him that this is what I want you to always do on a day-to-day basis. So whenever there's that master-servant relationship with the so-called mutual obligations, that will always be deemed to be an employment relationship. On the other hand, a consultancy relationship is the one where, a consultant is looked at as an independent contractor, someone who is coming in. No one will dictate on him in terms of, how to deliver whatever he's supposed to do. So the contract will always, talk of, this is what or rather, this is the deliverable I expect from you. Yeah. So if you are in a situation whereby it's already put down in paper that these are the specifics that, the duties and obligations that I want you to do, then definitely that is an employment relationship. But if it is a relationship where it is you coming to say that I am coming to do the following, then that will be a consultancy relationship. Now, the other criteria is what we call integration. Now, this is a very simple one. An employee, you will always, expect him to enjoy certain, facilities or advantages of the employer. Yeah. So, for instance, when we talk of as an employee, maybe your employer can decide to take some life insurance cover for you. Or maybe your employer can decide to, for instance, dictate on your working hours. Yeah, if you have a contract which says you are an 8 to 5 person, yeah, definitely that means you qualify, or you'll definitely be deemed to be an employee. On the other hand, if you are not, integrated into the organization, yeah, talk of the issues of working hours, talk of the issues of enjoying advantages like, maybe being in the medical scheme for that organization. Yeah, just being part of them, being integrated into the organization. If you are not in any way integrated into that organization, then definitely you'll qualify to be a consultant. Now, the third criteria is what we call control. So this has to do with the independence bit. Yeah. Obviously, a consultant is not expected to be directed or guided or monitored in terms of what he's doing. A consultant is an independent person, is an independent contractor. He should not be controlled in any way in terms of how he delivers his work. On the other hand, an employee is always a subject of his master, yeah, going back to that master-servant relationship, yeah, he can be ordered in terms of the tasks that he's supposed to do, or he's given a job description and that is all he's expected to do. He can't go over and above what is expected of him. Now, this is where the whole issue of reporting lines also comes in. You cannot say that you're a consultant and yet there's a reporting line that has been given to you in terms of this is the boss you report to. Yeah, as a consultant, you're your own boss. Yeah, you should not be reporting to anyone. Now, that's different from, maybe reporting your deliverable. Yeah, that's different. Maybe you are given, you came in as a consultant to deliver, a certain task, and you're just going back to explain what you've delivered. That's different from someone else who is told that maybe prepare quickly reports on what you've done to this person, or always seek the consent of this person before you do 1, 2, 3, 4, or have your work reviewed by this person. Those reporting lines will always deem you to be an employee and not a consultant. The last one, equipment, has to do with facilitation. An employee is the only person who is expected to maybe be provided with tools of trade. Yeah, you cannot say that you're a consultant and yet when you go to that facility, when you go to that hospital or that clinic, you expect them to provide everything for you at no cost. Let me just be particular on that, because there's a difference between maybe as a consultant, you say that you're coming with your patient and you want to use maybe the theater of that facility and they invoice you for that. That is different from a scenario whereby they call you and tell you, we have a patient here whom we want you to treat, and they go ahead and facilitate you. So if they facilitate you, then you become an employee for tax purposes. But on the other hand, if you come with your own tools of trade, then you qualify to be a consultant. Yeah, but then I'm sure you guys know how to go around it, because I'm aware, in most instances, all these costs of facilitation will always be borne by the patient. So it is always important to have that arrangement documented in a good manner. For instance, if you have all these contracts with the hospitals or the clinics, it's important that some of those clauses make it very clear that indeed it's not a scenario whereby they end up facilitating you. Okay, so let's now go quickly to the aspect of how to compute your numbers. Again, when it comes to now the calculation of your taxes, it should not purely be an exercise of your revenue minus your expenses. From a tax perspective, we always have some criteria in terms of what expenses are allowed and what expenses are not allowed. And that is why it is always important to, for instance, consult a professional when you're doing your numbers, because probably, they would be best placed to guide you on, what is allowable and what is not allowable. At the same time, they will also be able to, advise you on some of these expenses which you might not be aware of, which, for instance, you might be able to utilize as expenses, especially for individuals. Obviously, for instance, those who are like maybe paying their own personal mortgages, yeah, you need to be aware that the interest element of that mortgage that you've taken qualifies as an allowable expense, which you should even take time. If you are in employment, you should even provide those details to your employer, so that when they are computing your pay as you earn every month, they are able to reduce your income using that interest element. There are those of you who have decided to take insurance covers, medical covers, education covers, yeah, whatever premium that you're paying, that to some extent is entitled to some tax relief that will reduce whatever you're paying. So there are a number of all these allowable expenses, which again, they always change over time. Yeah. Remember, in tax circles, we always say that every year is a different year. Whenever you hear the budget cycle coming in and there's a finance bill to be discussed in parliament, what they always do is to discuss how to make changes to these tax laws. So that's why it's always important not to assume that whatever I did last year is what I'll do this year. There are some things that always change abruptly. In fact, I can just give an example. Back in 2020, when the corona crisis came in, there was this deletion of all these common expenses. For instance, are you aware that whatever subscriptions that maybe your facility, so now here I'm referring to maybe those who now are operating facilities with employees and all that, when you're doing your profit and loss account, for tax purposes, you'll not be allowed to, for instance, expense the payments or the subscriptions that you're making to your professional body. That was stopped, from the year 2020, when they decided to revise the pay-as-you-earn rates, and the tax rates during that year were also lower. So they were able to remove some of those expenses, and up to now they're yet to bring them back, because again, it doesn't really make sense to deny a doctor that opportunity to recognize an expense for a subscription he has made to the professional body. And yeah, it's across board for all professions. That's something that we are all watching for and fighting for, so that it's brought back. Okay, so just a simple table to just tell you what a profit and loss account would entail. So here we will always talk of okay, the basic revenue minus expenses that you have. But when it comes to tax computation, I will always go back and make the adjustments to remove what we call the non-allowable expenses and expenses relating to exempt income. So expenses relating to exempt income here, for instance, is like now the interest from the CBK instruments that I was talking about. That's an example of an exempt income, which if I see it in your breakdown, I'll say this one. Okay, the expenses related to it should be added back, but on the other end, that income, I will remove it from your tax income. So basically, this is what you're supposed to show at the end of the day in your return. So let me just quickly display that Excel return as we know it, the iTax one, so that I quickly guide you on how you'll always be able to go about it. Okay, so this is the normal Excel return. The normal template, the normal format that you'll always be expected to fill in. Now, I just want to quickly take you through some of the basics here, yeah, especially when it comes to these questions that you're seeing from number 7. So this question is very, very important, especially when it comes to a situation where you have other sources of income, which other sources of income other than employment income. Yeah. So if you're a consultant, always say yes to this setting. If you are running a health facility, always say yes to this setting. But again, when you're running a health facility, it also has to do with whether you registered it as a company or you're running it as a sole proprietorship. So if you're running it as a sole proprietorship, it means the taxes must be accounted for in your personal PIN, and that's why you'll always have to answer yes. So the minute you answer yes in this setting, I just want you to watch what will happen. The minute I say no, you'll see the worksheets down here that disappear. Yeah, the profit and loss and the balance sheet and a number of other worksheets disappear. Reason being, an employee is only required to just fill in the details of what we call the P9 form, and other advantages that they've been enjoying during that year. But the minute I say yes, a number of worksheets will always automatically come in. The profit and loss, the balance sheet, as you can see them down there, and those are the two key worksheets that you'll need to fill in. Now, this question on do you have partnership income, again, this is also very important. I know in your profession some of you will always opt for that registration. You register a partnership, and what the law says about partners is that at the end of the day, a partnership is not a person. So the taxes for that partnership should ultimately be accounted for by the individual partners. So if you look at what we always call a partnership return, what it does is it just goes and distributes whatever income or whatever profits and whatever advanced taxes that have been paid. It divides them among the partners. And the minute it divides them, it becomes important that when the individual partners are filing their own returns, they're supposed to come here and say that, yes, indeed, they have partnership income, so that there will be a special worksheet that will come in where you'll be required to put in details of that partnership business that you have or you've been getting income from. So allow me to skip that question on trust income. It's not relevant for us today. Now, there's that aspect of, has your employer provided you with a car? Again, those who are in employment, these will always be very relevant because you'll be required to put in the details of how you arrived at what we call the car benefit. Now, the issue of the mortgage, I already mentioned this. There's quite some savings that you'll get if you are able to confirm here that you indeed have a mortgage. So you just say yes, then you put in details of that mortgage that you have. Again, there's something else that is not that common, a home ownership savings plan. Again, you can always enjoy some savings on that. The issue of insurance covers, again, you can always enjoy on that. Now, this issue of a commercial vehicle, yes, you can be a doctor, but maybe you have some matatu on the road, which is earning you some money. Remember, these commercial vehicles, whenever they go for inspection, they're required to account for what you call advance tax. Now, that advance tax should be used to reduce the ultimate taxes that you pay at the end of the day. And that's why you're being asked whether you have that commercial vehicle, so that there'll be a schedule where you'll be putting the details of the advance taxes that you already paid in that year, and that will be used to reduce your tax burden or your tax liability. But remember, it implies that you'll be owning up to say that in my profit and loss, I've included the income from the matatu in my business income. Okay, the issue of foreign, the issue of income from foreign countries. Now, this is where if you would want to take advantage of maybe the double tax reliefs that are there, yeah, you'll be required maybe to say yes and give details. Again, now row number 16, the one for disability. Again, remember there's that exempt limit. There's that exempt limit for persons with disabilities. It's an income limit below which they are not supposed to be taxed. So if you make money over and above that limit per month, it's usually around 150,000 per month. You're not supposed to pay taxes if you're below that. But then again, there's usually a procedure that you need to follow. You need to actually pursue an exemption certificate from KRA before you're able to come and enjoy that exemption. Ideally, they'll issue you with an exemption certificate. So when you say yes, it will ask you for that number in your certificate, so that that exemption is automatically applied in this return that you're filing. Then that aspect of declaring your wife's income, yeah, this is a bit outdated because the law actually opened it up. Previously, there used to be that requirement that, the husband would be the one responsible for declaring and accounting for both his personal taxes and his wife's taxes. Okay, Now, that portion for the bank details, as you see, it's now grayed out. But what happens is that the minute you finish putting in your numbers and it declares that maybe you've overpaid taxes, then this section will automatically activate. Reason being, the taxman expects you to apply for a refund, and they would want to channel that directly to your bank account, and that's why they'll ask for your bank account details. Now, that part for the auditor, again, this is outdated because what happened is that currently, especially for those who are running companies, the Companies Act was able to give a threshold for entities who must audit their books. So if you make a turnover of less than 50 million shillings in a year, then you're not, it's not mandatory for you to or have your books audited. Yeah, so that's why this portion you can always leave it blank. Now, this portion for the landlords, again, what happens is that, let me just go to the next worksheet for profit and loss. As I explained that, what happens is that this profit and loss usually has the itemized, expenses and itemized incomes. The minute you come in under the itemized line for rent, yeah, rent expense here, you'll find it under line, yeah, row number 65, yeah. The minute you indicate any figure under that row, then this return will want you to put in the details of your landlord here. Yeah, I know how difficult it is to, get your landlord to give you these details. So what I always advise my clients is that if you want to skip that, then you're better off leaving that row blank. But then there's a table here for other expenses where you can just put in the name of the expense, rent, and put the amount. Yeah, so that it doesn't ask you for your landlord's details. Now, this page for the profit and loss brings out the concept of the separating of the sources of income that I have already mentioned. The reason why all these columns are there, it is in order for you to be able to keep track of the numbers in each and every source, separate source of income. Then at the end of it, later on, you'll see where it even allows you to utilize losses for the specific source alone. So that's why that mix-up should never happen. So the profit and loss, as I already mentioned, yeah, it's where you're supposed to just put in your revenue and your expenses. Now, the balance sheet, this is where I would not want to complicate it for you. Reason being, the taxman has also realized that indeed, not every taxpayer is, a qualified accountant, and it will be very difficult to dictate upon them to accurately, fill in what we call a balance sheet. So what I always recommend, it is allowed. You can just come in under what we call the assets. Yeah, under the assets, in any of those rows, you can just type in even number 1, because the return will not allow you to leave it blank. So you can even just, for instance, I just come here and say under current assets, I can just select other assets, and I just type in number 1. And then I have to go down under the category for liabilities. Yeah. Under liabilities, I can even choose, let's say, the proprietor's capital, and I also type in number 1. So the essence here is that it must balance. Yeah, that's why it's called a balance sheet. So assets and liabilities must always balance. So yeah, we don't. No one wants to take you to an accounting class now to get you to understand all that. So that's the simple trick when you want to, run away from, an accounting class. Now, I will also skip all these other items, the stock, because they're not relevant to you and all that. But for those who are running health facilities, it will be important for you to consult, a professional when it comes to this worksheet for its written IDA, investment deduction allowances. What happened is that, especially when Corona came in, there were all these incentives that were being directed to the medical sector to actually incentivize them to, for instance, build or expand their facilities. And what would happen is they would enjoy the so-called investment deductions, yeah, at a rate of right now it's standing at 50%. But then again, last year again they were able to improve them, and depending on maybe how much money you've put into that facility to construct it, you can even qualify for 100% deduction. So what I mean by 100% deduction is that the total cost of that facility will be recognized in your return here as an expense, such that if your revenue minus that big expense ends up in a loss, that loss you'll be able to even carry it forward until you fully utilize it in whatever number of years. So you might end up not paying any taxes until you recover the cost of that facility or that expansion that you undertook. So it is important for you to consult on how to enjoy that. Now, let me skip all that and go to employment income. Now, under employment income, what I would want you to understand, I actually preferred to log in onto iTax and demonstrate to you, but I realized the system, iTax, the iTax system is a bit down, unfortunately. As you can see, I'm just trying to log in, but yeah, I think there's a downtime. So unfortunately, I'll not be able to show you that, but maybe you can note down for those who are purely earning employment income, and that is what they want to declare for tax purposes. You do not need to go through this entire process of filling this Excel return. What you need to do, and maybe this is something you can note down, once you log into your iTax, you will go to that tab written returns, and on the drop down, you will see an option written return for employment income only. Yeah. So once you click on that option, it will ask you whether the only income you're earning is employment. And once you say yes, it will go ahead and now take you through a number of pages, which will basically display what should match your P9. Yeah. Those pages, actually what you'll be doing is just to confirm that those numbers are right, and you'll just be clicking yes, yes, yes. And ultimately, the last page of it, you'll just need to go and fill in. There's a row that takes care of, or actually that row is similar to, let me just show you here. It is similar to what you have. Yes, it will be similar to this. So there will be this row that will require you to indicate your pension contribution. So if in your P9, both your NSSF and your maybe private pension contribution, as it appears in your P9, you need to put in that entire figure here. The law will allow you to put up to a maximum of 240,000. If you're only paying NSSF at the old rate of 200, that's why you can see there are filled in 2,400 shillings. Now, the other item you need to be careful on, there will be a row written personal relief. Make sure you also fill in that row, 28,800 shillings. That's the current, relief for the whole year. Now, once you fill in those two, yeah, once you fill in those two, then you should be ready to just click on submit. Yeah, but always be sure that that last line, written tax due, yeah, if you are purely earning employment income, if that last row, written tax due, is showing a positive, that should ring an alarm bell on you, in that it's a scenario whereby either your employer has not been remitting the pay as you earn, yeah, and before you even file your return, it will be important you go and consult your employer. You can just take a screenshot of that page so that you face your employer and ask him, what's happening here, so that he will be able to address that. Because the minute you go ahead and file that return with the liability, you'll start receiving those demand notices, and it will go on record that you are in arrears, it will earn interest and penalties and all that. So it will be important for you to always check out for that. Now, if you are a person who is earning multiple sources other than employment income, then it is a must that you fill in this Excel that we are talking about. Yeah. So we were at this worksheet for the employment income. Again, what you're supposed to do here basically is to key in what you have in your P9 form. Your P9 form definitely always has all these categories, you know, for your gross pay, allowances, benefits. So you just put the total amount that is appearing at the bottom. Now, what I want you to be careful about is this other second worksheet, written details of pay as you earn deducted. There's a common mistake that people usually do. This column, written taxable salary. Please note that what you should indicate here is what corresponds to that column, written chargeable pay. If you look at your P9, there's another column, written chargeable pay. That amount is what you should always indicate here. So don't make a mistake of indicating your gross pay here. Indicate your chargeable pay and a taxable salary. That is very, very important. And then the tax payable, and then again, your P9 always has that column for the tax payable. And then for the pay as you earn, this is always the last column in your P9. So make sure you key in those numbers correctly. Ordinarily, this last column should purely be made up of the difference, or rather the amount that should appear there should purely be either a summation of your insurance relief plus your personal relief. Yeah. So if you don't have insurance relief, it should purely amount to your personal relief, so that when you now go and to the last worksheet, you'll see that at the end of the day, if your employer paid all your pay as you earn, it should read 0, or maybe some slight overpayments, some negatives, which again, if you don't want to go into a refund position, you can always play with the numbers to get it to read 0. So that is it for employment income. For those who are in partnership, again, this is the worksheet I was telling you about, whereby, remember, for a partnership, when you're doing your accounts, some of the things that will always happen is that at the end of it, there will always be a share of profit or a share of loss. Yeah. So that should come out clearly in your partnership books of accounts. Again, I would always recommend you consider engaging a consultant in order to handle that for you. Okay, so that should be it when it comes to filling these return. Most of these other worksheets, you'll realize that they're all grayed out and you might not need to fill them in. Let me just mention the installment tax credits. For those who are in business income, this is what the law says. If in a year of income you have declared or paid a total tax liability of over 40,000 shillings, then in the subsequent years, you are supposed to pay your income taxes in advance in a mechanism called installment tax. So installment taxes are usually 4 in number, and the first installment is always paid before the 20th of June, 20th of April. The second one is paid before 20th of June. Third one is paid before 20th of September. Last one is paid by 20th of December. So how you compute those installment taxes is that you are supposed to assume that the taxes that you paid last year will increase by 10%. So you mark up your previous year taxes by 10% and divide it by 4 and pay it before those dates that I'm talking about. So that will only apply to those who are reporting the so-called business income and their prior year returns declared taxes, a total tax liability that was over 40,000 shillings. So that is also important, and you need to also consult a professional in order to understand that more. So what happens at the end of the year, when you're filling in this return, you might not need to pay additional taxes. Reason being, you will be required to come in and put details of all the installment taxes you paid within the year. So ideally, it's a mechanism of collecting taxes from you in advance. Okay,
so how many more slides?
Sorry?
How many more slides? Or how many more minutes so that you could also move to Q&A?
Yeah, I'm actually winding up.
Thank you.
Yeah, just 2-3 minutes I'll be done. Because I just want to quickly talk about this worksheet for the previous year losses. So this is the mechanism where for each separate source, you'll be required to record whatever losses that you've been putting, and this is where you'll be able to keep track of them. Now, this last worksheet is the one that now sums up everything that you've put in this return. And just like I had already mentioned, the numbers will automatically pick here, and you'll only be required to fill in your personal relief and your pension contribution. But for those who are reporting business income, remember there's this row number 25 where you're supposed to indicate your withholding tax credits. Yeah, and those who are in Matatu business, there's that row for the advanced tax, which you're supposed to put it so that it reduces your tax burden. So once you're done, you just click on validate, and if all goes well, you should be able to go ahead and now upload that Excel return in the system. Yeah, so that indeed marks the end of the filing of the tax return. And the only final slide I have here has to do with what we call the withholding tax. Now, what I really wanted to mention, because I know these slides will be shared with you guys later on, I would really want to now talk about those who are probably running health facilities. And to some extent, they will always be exposed to scenarios where, let's say, they are paying the consultants. Yes, obviously, there's always that 5% withholding tax that needs to be accounted for. There's that threshold of 24,000 shillings. So if you pay them less than 24,000 shillings in a month, no withholding tax will apply. But if it's above, then you should always apply that. Then again, if maybe you're engaging some guys to expand your facility, guys who are engaged in building, the withholding tax rate is 3%. So before you pay them, make sure you deduct the 3% withholding tax. At the same time, maybe within your facility, you've been able to subscribe to some, those special softwares, for running your facility. Again, anytime you're making payments to those developers, software developers, remember there's a withholding tax of 5% if they are resident here in Kenya. But if you're paying an unresident developer, maybe you've even subscribed to, let's say, the Microsoft 365 programs, make sure you deduct the 20% withholding tax. Again, when you're repaying your loans and there's interest, as long as this is a loan to a lender who is not a financial institution, you will be required to account for the withholding tax. But if you're paying it to a bank, to your SACCO, no withholding tax should apply when you're paying that interest. Okay, that should mark the end of my presentation. Yeah, I think you'll receive the slides and you'll be able to see the rest of the withholding taxes. Now I should be able to look at your Q&A. Yes.
Thank you, CPA, for the elaborate presentation. Of course, matters, figures, and tax is quite detailed, and I think you've tried to capture it so well. We have so many questions here, so just try to be brief because time is going on. We are probably 1 and a half an hour on. So the first question is, assume you're running a self-catering facility. How do you declare the income? Do you combine it with the MRI or yearly rental income return?
Yes, as I mentioned, MRI purely applies to residential rental income. Yeah, so that monthly tax that you pay on your gross monthly rent, that exempts that income from being taxed further. That's a final tax. So for the so-called self-catering facility, maybe you can correct me if I'm wrong. Do you mean your own property? Okay, property in your own name, which you are now also running your clinic per se. Maybe you can correct me.
I presume so. I was also trying to figure it out, and I think that is what they probably mean.
Yes, so in that case, any income from that facility will qualify as business income. That will not qualify under MRI. Yeah, so maybe the next question, withdrawing from SACCO, the reimbursement of your saving deposit, does it attract any taxation? Kindly touch a bit on taxation of retirement benefits. Yeah, that's a good question. Yeah, definitely SACCOs are always deemed to be getting money from already taxed sources. So what I mean by already taxed sources, you are employees of a profession, and whatever subscriptions you make to your SACCO will always be assumed to be from taxed sources. And that's why whenever you're withdrawing from that SACCO, no tax should apply. Yeah. Now, on the other end, there's the issue of reimbursement of your saving deposit. Yes, again, nothing, this should not be further taxed. What I need you to understand is that all the taxes that the SACCO accounts for on your behalf will always be treated as final taxes. So any income, even the dividends you get from your SACCO at the end of the year, never declare them in your tax return again, because whatever taxes that were accounted for by your SACCO, those were final taxes. When it comes to retirement benefits, again, what happens here is that it depends with the type of scheme that you are contributing to. Now, we have what we call registered schemes and unregistered schemes. Basically, unregistered schemes include all those, maybe for those who are employed by international bodies, and maybe you're forced to join their foreign pension schemes. Those are what will always sit in as unregistered schemes. Now, if you are contributing to an unregistered scheme, what happens is that whatever amounts that your employer is contributing to that scheme will always be taxed on you every month. If you look at your payslip, they ought to be including that as a benefit for you, and it will always be taxed every month. Then the moment you retire or you withdraw from that scheme, it will not be taxed any further. You're not supposed to declare it again for further taxation. On the other hand, when you talk of contribution, sorry. Okay, yeah. When it comes to contributions to registered schemes, what happens is that you are exempted up to a limit of 20,000 shillings every month in terms of the contributions that your employer is making. So what happens is that since you enjoy this exemption in the lifetime of your employment, the moment you withdraw from that scheme or the moment you retire, that is when that income will be taxed. The tax tables that I would recommend you always consult, your a professional, and they'll be able to guide you on that. But the beauty here is that the taxes on those benefits, the pension benefits that you'll be receiving, must be accounted for by the scheme. So they always do it in a withholding tax mechanism. So that's why whatever you receive at the end of the day, don't bother declaring it any further for taxation. Now, let me go to the next question. If you make a loss selling shares, do you need to file in your returns? Are these taxes taken at source? Now, as I mentioned earlier, these will be classified under capital gains. Now, capital gains, again, is a final tax. So what I mean by a final tax is this should never be declared in this annual return that I've taken you through. What happens is that the moment you are undergoing that transaction, you will realize that your transaction advisors will always guide you to go to iTax and declare under the so-called capital gains tax regime. So under that capital gains tax regime, you are even allowed to report a loss. Yeah, and that loss you can always go back and always utilize it in subsequent transactions. So it's just that iTax is malfunctioning right now. But yeah, if it was okay, I would be able to take you, at least you see how that is done. But definitely your transaction advisors will always guide you on that. Next question, which professional is the best qualified to assist in filing the income tax returns? Now, my advice would be that any CPA should be able to, understand these processes. But the most suitable persons is those who are qualified or registered tax agents. Right now, there was a mechanism that KRA put into law, and it was able to come up with this system of registering tax agents, but they would take them through some elaborate interviews and frisking of their papers and all that. So anyone who is a registered tax agent, that would be the perfect person to take you through this. Next question, is it necessary to include income from a tax exempt agency, for example, UN? Yes, good question. Now, what I've always been recommending for the UN guys is that they should just be filing nil returns. And again, on iTax, if you're filing a nil return, no need to download these Excel sheets and all that. If you go to that tab, written returns, you'll see there's a last option called file nil return. And all it will ask you is, are you sure you want to file a nil return? And you just do that. Yeah. So no need to complicate it any further. Next question, is per diem for attending meetings taxable? No, not at all. Per diem is not taxable. But at the end of the day, remember, even the burden or the responsibility to see whether it's to determine whether it's taxable or not lies with your employer. Now, your employer should know that the condition for not taxing per diem is that for any amount that is over 2,000 shillings per day, that employee should come back and present proof of expense. So whether it's receipts or whether it's an analysis of how you spent that money. So remember, the limit right now as per the law is 2,000 shillings per day. So if your per diem is 2,000 shillings or lower or below 2,000 shillings, you do not need to support how you use that money. But the moment it surpasses the 2,000 shillings limit per day, make sure you provide the supporting documents if you don't want it to be taxed. Next question, hi, could you please tackle the withholding tax aspect of 5% with respect to locum? Is the 5% tax final? No, it's not. Remember, I said, the locum falls under consultancy income, it's business income. So withholding tax on such incomes is not final. So the only instances where withholding tax is final, if I can repeat, interest income, withholding tax is final. Dividend income, withholding tax is final. Income from what we call investment assets, there's what we call collective investment schemes. For example, those who go and purchase unit trusts, maybe from Old Mutual, from Britam, or from Saiton, for those registered schemes, no need for you to, or rather their withholding tax is a final tax and you should not declare that further. Next question, what are the tax obligations for a Kenyan who has been resident in Kenya from Jan to June, then gets permanent residency status and emigrates from July to December? Yes, now the first criteria I said is what we call the permanent home criteria. So the minute your personal and economic interests are deemed to be always here in Kenya, irrespective of whatever period you are in Kenya in that year, you'll be deemed to be a resident. Now, if you didn't have a permanent home here, yeah, so probably you are a foreigner, so you didn't have a permanent home here, then we now go to the criteria of the number of days that you are around. And here we are talking of 183 days. So when you tell me January to June, you are here in Kenya, I'll assume that will, clock the 183 days. Therefore, you'll be deemed to be a resident and you'll be required to account for taxes on all the incomes, both in Kenya and from the foreign country. So you will only be rescued by, if that country has a double tax agreement with Kenya. Next question, how do you handle travel expenses between your private practice place, where you are paid as a consultant, and your normal pay-as-you-earn job? Yes, so this is a very common question. So when it comes to the issue of travel expenses, what needs to happen, or rather what I always recommend, I always recommend that you go for what we call a mileage claim approach. Mileage claim approach is more, it can be easier supported, whenever maybe the taxman comes to challenge it. Reason being, you will be required to maintain a record of maybe the number of kilometers you're covering for your consultancy business. Yeah. So for instance, if you are maybe at your home or maybe from some certain clinic and you are heading to an appointment for some consultancy somewhere, you need to clock the mileage, starting kilometer, end kilometer, and then internally you can have your own policy. There's always a recommendation that you use the AA rates. Yeah. AA usually publishes some allowable rates of how to refund yourself per kilometer. Yeah. So what that means is that you can draw money from your business in the name of travel expenses, but that will be supported by this record of the number of kilometers that you used your personal car, to go for the, consultancy travels. Okay. Most county governments do not submit pay-as-you-earn collected, and KRA harasses us instead of them. Yes, very good question. Now, I want to point out some unique aspect when it comes to employees in the public sector. What happened is that there's that portal that you always use, the government portal that you always use, which again, you can always go and even download your P9s and all that. Now, that portal was linked with iTax. Yeah. So that I can confirm it is true that was done. But unfortunately, what iTax is doing, it will only allow you to get those credits to be reflected in your iTax account if you are only earning employment income. So what I mean here is that if you are moonlighting and maybe there are some withholding tax credits that were accounted for by your customers or your clients, and these credits are showing on iTax, then you'll have problems in terms of declaring your employment income together with that business income, because those credits from that government portal will not show, will not appear. So this is a technical thing that has been there for a while, for like 3 years. Whenever we approach the tax authority on how they'll be able to handle these, they're always telling us that, okay, they're doing it manually in terms of, feeding the iTax system with those credits. And one thing that happens is that you might think that it's your employer who hasn't accounted for those taxes. But in real sense, your employer indeed accounted for those taxes, because what happened is that there was an arrangement between KRA and the government such that KRA would always collect these monies at source. Yeah. So when your county is processing your salaries, the county will not be paid, the pay as you earn. That would be directly be directed to KRA. And that's why, KRA will be required to now rely on the data that is on the government's HR portal. So this is more of a technical issue. It's an anomaly that KRA is aware of. They are working on it. But what I'm assuring you, for those who are purely earning employment income, you should not be complaining in any way. Reason being, if you go for that.
Yes, just address also there's a bit of people who've not received their withholding certificates.
Yes, once again, if you go to your iTax account, there's a way you can know whether your withholding tax credits have been accounted for or not. Now, there is a tab called Ledger. There's a drop down. There's a second option called General Ledger. If you click on that General Ledger report, it will display for you on the right side, the credit side. It will display for you any withholding tax credits that have been accounted by your clients. So the minute you realize that some of them are missing and yet they deducted it from your pay, you can actually face them with a screenshot of that page. That screenshot, you can actually face them with it and tell them that, you know, your amount is not reflecting here. It means you haven't paid it. So that's very important. Okay,
Then,
the next question.
There,
Yes.
there are two questions that are asking on people who work in two facilities, and apparently the two facilities deduct 30%. Is that okay? Yes. Two different facilities for the same person.
Now, if you have two different employers, what happens is that the law says that only one of those employers can classify you as a primary employer. Now, let me explain that concept of being a primary versus a secondary employee. A primary employee will be able to enjoy the graduated scale. Yeah, you know, for individuals, the tax rates range from, you know, the 10% to the 30% at different levels. So that table, you'll be able to enjoy it for the employer who declares you as a primary employee. At the same time, the personal relief of, you know, 2,400 shillings per month will only be enjoyed by the employer who classifies you as a primary employee. On the other hand, an employer who classifies you as a secondary employee will deny you that aspect of your taxes being subjected to the graduated scale. At the same time, you'll be denied the personal relief. But the correct treatment should be that make sure you decide which one of those two employers should declare you as a primary employee. So you're the one to dictate that and advise one of them and tell them, on this other side, I've agreed to be treated as a secondary employee. That means you must declare me as a primary employee. The net impact is that at the end of the year, when you are computing your taxes, remember, if you had already gone above the 30% scale, we're talking of maybe over 48,000 shillings. If you had already crossed that scale, any other income you're getting from any other source will always be on the 30% bracket. So there's nothing wrong in having one of those employers to treat you as a secondary employee, which will outrightly tax that income at 30%. But it is wrong for both of them to treat you as a secondary employee, and you need to correct that. Yes.
Thank you. There's a question that people who've retired, are they meant to get their P9 forms from the previous employers? And how do people also go about getting refunds from KRA? Someone hasn't succeeded.
Okay. The first question in terms of getting their P9s, I believe they would want that for purposes of clearing with KRA, you know, maybe getting the tax clearance certificates. Again, it is the responsibility of your employer to give you or to issue you with the P9, the tax deduction card. So there's no way out. That one, it's only your employer who should be able to do that. So it's unfortunate if maybe your employer closed down and all that. But then once again, that should not make KRA to deny, you know, listening to you and your case. Yeah. At the end of the day, they should be able to, you know, maybe ask for other ways of establishing your income. You know, like now, for instance, if you give them your employment contract, that should be able to guide them on what income you are earning. So if maybe we are talking of a scenario whereby maybe there were errors in your statements at KRA, they should use your employment contract to correct them. But then again, if it's a scenario whereby your employer maybe didn't account for the pay-as-you-earn credits, those are the scenarios where you will always enter into trouble, especially maybe if your employer closed down and all that. Yeah.
What is the best one for? Okay, just combine that with which is the better one for somebody who's running a business? Sole proprietor, partnership, or company in terms of tax matters?
In terms of tax matters, remember, because individuals or sole proprietors are subjected to the graduated scale, yeah, it means the taxes will always be less, yeah, compared to a company or an incorporated entity, which is straight at 30%. But the difference is very minimal, yeah, it's not that much. Now, the other reason why people would always prefer to go for the companies is that in the event that like now instances where you are also in employment and you are also moonlighting, there are always those difficulties or challenges that you will have the moment it is discovered that maybe your taxes were not fully paid under your personal tax account as a sole proprietor, because you'll not be cleared, you'll not get a tax compliance certificate if there are any problems with your business. Let me just give a good example here. KRA will always regularly come for the so-called audits. Let's say they come for an audit and there is, raise an additional assessment on your personal PIN as a sole proprietor. Yeah, those are things that will, let me just use the word, datify your account. And if you would want to separate your business and you as a person, it is always important to go for the company option. Lawyers will also recommend that you always go for the company option. Reason being, there's what we call the limitation of liability. The question on, what was the other question? Or can I just read out what is here? Please clarify on making returns for withholding tax once you have a certificate fails to balance at times. Yes, of course, what happens is that withholding tax only accounts for 5% of your income. At the end of the day, our tax rates, are capped at 30%. So it means if, for instance, you had already exhausted your, whatever income that is below 30%, maybe you exhausted that in your employment, and it's your consultancy that you now need to declare. It means there's a 25% balance that you will always need to pay to KRA. But this will now depend on your profit and loss. Yeah, because again, that income, you are allowed to reduce it against expenses. So whatever profit you make, it is always assumed that you only paid 5% taxes. So this balance that remains, the deadline for paying it is always the 30th of April. Yeah, by the 30th of April, you ought to have done your numbers and paid that balance to KRA, so that by the time you're filling in your return, yeah, you should just go and you saw that worksheet for there's that row I showed you for withholding tax credits. You just go in and put in your withholding tax credits there. Then there's also another worksheet for payment credits, where you go and say there's this final tax I paid on 30th April. That should make sure that your return balances. So ideally, what we are saying, this return, you ought to have filled it so that you be sure that it will tie before 30th of April. Because if it doesn't tie, it means whatever is there is a balance that you ought to pay by 30th of April.
What if somebody has a mortgage in a foreign country? Do they have to declare it?
No. The mortgage relief only applies to mortgages from financial institutions here in Kenya. So that's the restriction.
What are the
so there's a question after
Yeah, you can go to that question that is a bit long. I recently did my tax returns. However, I couldn't fill the part for personal relief because the Excel sheet kept on reporting an error and indicated that I could only fill a maximum of 13,914. My personal relief is
that was a system. Yeah, that was a system problem that has already been resolved. In fact, for those who are maybe trying to file their returns in early January, yes, there was that technical hitch. But right now, if you go and download that Excel, it allows you to put in the maximum personal relief of 28,800 shillings. Yeah, but then again, I will always encourage those who are purely earning employment income, don't go to fill that return. Just go directly to iTax, go to the returns tab, go for that option written for employment income only, and that's the easiest way to complete your return.
After resigning, giving a 1 month notice, I went on leave, started my new job, so I received 2 salaries last June. How can this tax be accounted for?
As long as this is employment income, I'm sure your employer already subjected it to the monthly pay as you earn. Now, unless you're referring to how would you account for this at the end of the year, definitely your old employer should give you a P9 for that. Your new employer will also give you a P9 for the period that you're in employment, and you should, declare them. Remember, in this Excel that I showed you, it allows you to declare multiple employers. Yeah. And then it will calculate for you accordingly. Now, I would want to answer that question from a perspective of guys who probably within some period in a calendar year, they were not in employment. What that means is that whenever you file your annual income tax return, you'll end up in a refund position. Now, once you end up in a refund position, remember I showed you that there's that first worksheet which will require you to indicate your bank details. Now, once you file your return that is showing a negative, which is a refund, then there is a tab written, refund claims. If you go to that tab, you should just go ahead and specify that the refund you're seeking for is income tax, resident income tax, resident, and then it will go ahead and show you the numbers that you had already declared in your return for refund. Then it will just ask you to put in your bank details there. And once you submit that application, make sure you print out that acknowledgement copy that you'll get. That acknowledgement copy is what you will use to follow up with KRA. Now, there was that question of how do I follow up for those refunds? I'll be honest with you that a lot has improved. A lot has improved. Right now, the moment you have printed out your acknowledgement, go to your go to what we call for those who are in Nairobi, go to 18th floor Times Tower together with that copy, and they'll be able to tell you the officer whom your application has been allocated to. And what that officer will demand from you, he will just want to understand why are you in a refund position. So for instance, if you say that maybe I resigned from one place and it took me 2 months to get another place, they'll ask you for the proof. They'll want to see that termination letter or that resignation letter. And the new employment, yes.
Now you could summarize this by responding to how do you go about getting tax reliefs from KRA? What are the examples of expenses that are allowed for locums or moonlighting?
Yes, let me go with the second one. When it comes to allowability of expenses, anything goes as long as you can defend that it relates to that source of income. So whether it is travel, whether it is meeting, what you call lunch meetings, whether it is rent that you're paying. So as long as you're able to justify that it supports my business, even marketing and all that, as long as you're able to confirm that it justifies your business, then that is allowable. But then I already gave that disclaimer that the law changes every year, and I was giving that example of the subscriptions. If you're doing your return this year, please don't include the subscriptions to your professional body as an expense, because that was outlawed back in 2020. So it's always important to just consult a professional for guidance on that.
Thank you.
The question on the tax reliefs. Okay, I suspect the question ought to be exemptions. How do you get exemptions? Because tax reliefs are automatic. All you need to do is, for instance, if it is insurance, you need to have an insurance certificate, a manual one from your insurance provider, because the day KRA comes to ask, why are you claiming insurance relief? What supporting document is that? You need to present that. If you're talking of mortgage, again, your provider, your financial institution needs to give you that loan statement, and even at times they give the mortgage certificates.
Thank you. I think this should be now the last one. If you're a shareholder in a company and have bought an equipment to use within the facility instead of the company providing the equipment, how do you file the tax returns? I think we can take that as the last question. Yes.
Okay, if you're using your own, maybe you need to be clear. Are you saying that you've bought
I'll
your
give you
own
an
tools?
example.
Yes.
I'll give you an example. Like, let's say there's a place where people are doing an X-ray center.
Yes.
A doctor is part of that X-ray facility, but the doctor's
Okay.
got their own CT scan machine. So they've incurred a cost in buying the CT scan machine by themselves,
Yes.
being used by the company. How is the tax calculated in that effect?
Yes. Good question. So if you go back to this Excel that I was referring to, that will fall under, okay, let me quickly share my screen here. Sorry. I think it's important so that you see where to put it. Okay, yeah, you can confirm whether you're now seeing my screen. Now, this is the Excel. Yeah, you're seeing my screen?
Yes.
Yes, okay. So now, there is this worksheet written, yes, here it is. This worksheet written E2, CAWTA, it stands for wear and tear allowance. So what happens with your own equipment is that you are allowed to claim an expense called a wear and tear allowance. Now, definitely this is complicated. If you look at this table, you need to classify it accordingly. And this is where I will always say you need to consult your professional. But, automatically for that X-ray machine, always put it under class D. Yeah, class D for 12.5%. So what happens is that within 8 years, for 8 consecutive years, you're required to claim the cost of that machine in terms of having it as an allowable expense in your tax computation. Yes, that is how it will work. You'll be able to spread the cost of that machine for 8 years. But for those who have put up, the buildings with facilities, those are the ones that you'll have to put them under this, what I call IDSCA. So this is called an investment deduction. So here you're allowed to go for the 50% rate, but then there's also a 100% rate, depending on the type of investment and where it's located and all that. So again, you need to consult a tax practitioner for more guidance on that. Yes.
Thank you, Samuel. I think you've really done a very great job, and we are grateful. I hope members have learned something. Of course, the questions are so many, but you've been able to answer the most that we could. So, members, this is Keme Sako, and over to you, Brenda. Is the chairman in? He can make a closing remark.
Chair, are you with us? Thank you so much, CPA Samuel. I'm sure this was very insightful. We've seen there's a lot of what we'd want to learn and have learned today. We'll share the presentation, and there's a survey at the end. Kindly, those of you who are with us, please fill the survey at the end. It helps us also identify our education needs as a SACCO, and just so that we can serve you better. Thank you so much, Samuel, and thank you, the guys at the office as well. And just to reiterate and remind you of TIBA insurance agencies, where you can get your professional indemnity, you can get your motor vehicle cover, everything you need under TIBA. So we'll link or we'll place the contacts on the chat box so that you can easily access them.
Okay, thank you. Yeah, so and for those who might want to consult further, on the slides, I have indicated my contacts, my email address, I think the phone number is there. And yeah, you can always, contact me through your SACCO and I'll be very willing to assist. Thank you very much for today's opportunity.
Thank you, everyone. Enjoy your evening.